Are you looking for a loan program that offers no money down with lower credit scores and lower income? If so, then USDA Loans might be the right choice for you. In today's video, we're going to be talking about USDA loans in detail. We're going to be talking about the loan requirements, what you need to satisfy in order to purchase a home with no money down using a USDA loan. So what is a USDA loan? A USDA loan is a mortgage loan is offered to rural property owners by the United States Department of Agriculture, which means yes, you have to live in a rural area in order to do a USDA loan. If you're here in Southern California where I'm located, there are no rural areas within a couple of hours away. But with that said, over 90% of the United States is eligible for USDA loans. And we'll talk about how to figure out if you're in one of those areas as we dive into today's video. But before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And also please subscribe to the channel to support the work I do here, along with staying updated on everything mortgage and real estate related. Now, the biggest benefit of a USDA loan is the fact that you can buy a home with no money down, absolutely no down payment. But as I mentioned earlier, your home has to be located in a rural area. So how do you determine whether or not the property you're looking at actually meets the requirements for a USDA loan? Well, I actually put a link in the description below where you can go and put in a property address to figure out whether or not the area that you're looking in is actually classified as a rural area. If it is, then you're good to go. Unfortunately, if it's not, then USDA is not going to be a loan option for you when it comes to buying a home. Now, the second thing I want to talk about when talking about USDA loan requirements that's different from all other loan programs out there is the fact that USDA has income restrictions. And that's because USDA loans are meant for low to moderate income families. So with that, your household income cannot exceed a certain limit, which all varies depending on the size of your household as well as the region that you're located. Now, again, I put a link in the description below so that you can go and check the area that you're looking to purchase in to figure out what the income restrictions are for that location. Now, when talking about income, it is household limit. So it takes everybody in the household that's actually working and combines their income, and your income has to fall underneath that limit in order to meet the USDA loan requirements. So if you're above that limit, then unfortunately it's like the property eligibility. You not being located in a rural area, you just can't do it. Well, if your income exceeds that limit, unfortunately, that's going to be another thing that USDA looks at and says that you're not eligible to purchase. And the primary reason I'm starting today's video by talking about those two things, because those two things are likely going to be the two things that limit people the most in being able to qualify for a USDA loan. So if you can check the box on property eligibility, yes, you found a property located in a rural area, and you can check the second box in that your household income is less than 115% of the area median income, then in theory, you meet the basic loan requirements in order to USDA. But on top of that, there are some additional things that we want to talk about in today's video. The property that you're buying has to be your primary home. It cannot be an investment property. It cannot be a second home, which basically means you're going to live in that home as your primary home when purchasing that property. Now, that's not to say that at some point in the future, you can't turn that property into an investment property and rent it out. But what it is saying is that when you're buying this home, initially, you're using it as your primary home. Now, when it comes to credit scores, USDA is flexible and does allow lower credit scores. They'll allow you to go as low as a 640 when it comes to your credit score. But something I always like to point out in these videos is just because you have a 640, you found a property in a rural area and your income meets those restrictions, doesn't necessarily mean you're going to qualify for a USDA loan. These are the basic loan requirements that we're talking about in today's video. In fact, you might talk to some lenders out there that require higher than a 640 when trying to buy a home using a USDA loan. So even though USDA allows credit scores as low as a 640, that doesn't necessarily mean the lender that you're talking to will do credit scores that low. And that could be because they have an overlay on the program, which essentially is an additional loan requirement above and beyond what USDA requires. But what I will say is when you have lower credit scores, it can often be more difficult to qualify even though you meet that loan requirement. Even though you have a 640 and meet exactly what it requires, it can be difficult to get the lender to lend you that money without having some compensating factors, which are things like money in the bank. Maybe you have a lower debt to income ratio, which we'll talk about here in just a minute. But if you're one of those buyers and you're just skating through, you're barely meeting the requirements, even though you meet them, you're just barely meeting them, chances are you're going to find it more difficult to qualify for one of these loans, especially when it comes to lower credit scores. So I always like to stop and take a break here and tell you how important your credit score is. Your credit affects everything. In fact, it's the most important piece of the puzzle, in my opinion, when it comes to buying a home, because your credit score affects your interest rate, which in turn affects your monthly payment. So the higher your credit score typically means the better terms you're going to get on your loan. So if you're someone going through this process and you're just barely skating by with some of these things, I often think sometimes it could be better just taking a step back and working on things like your credit to put yourself in a better position so that you can end up getting better terms at the end of the day. Now, one of the additional loan requirements that USDA loans have is that you need a debt to income ratio less than 41%. Now, before I dive into what a debt to income ratio is, understand that that's not necessarily a line in the sand. USDA will typically allow you to go a little bit higher on your debt to income ratio when you have some of those compensating factors like I mentioned earlier. If you have a higher credit score, maybe you have some money in the bank, even though you don't need it, you have some money in the bank that's there that the lender can see. When you have some of these additional things, it typically allows the lender to say, hey, you can go a little bit higher on that debt to income ratio, maybe pushing it as high as a 44, 45, or even 46%. But if you're watching this going, Jeb, I don't know what a debt to income ratio is. What does that even mean? Well, your debt to income ratio is essentially how the lender determines how much you're pre-approved to purchase up to. And how they get that number is they take your gross monthly income. Now, your gross monthly income is your income before any taxes are taken out. Now, in these videos, I always use $120,000 because it's an easy number to calculate. But every time I do these videos, I always have people say, Jeb, why are you using the gross monthly income? I'm actually paying taxes. I'm paying money into my 401k. I'm paying money into a deferred comp. And unfortunately, I got some garnishments on my check too, and I have to pay child support and or alimony. So I'm not actually receiving the gross monthly income. That's just what I make per year before anything comes out. Understood. But you have to realize each person out there has different exemptions, different things coming out of their checks. Some pay taxes in different ways. Some people don't pay into a 401k where others do. So in order to keep everybody the same, the lender uses your gross monthly income. So as I mentioned earlier, we're going to be using $120,000 per year because it's an easy calculation. Well, that breaks down into $10,000 a month because we take the 120, we divide it by 12 because that's how many months are in the year, and we come out to $10,000 a month. So now we have your gross monthly income. But in order to determine your debt to income ratio, there's two different ratios that we need to consider. You have a front end ratio and you have a back end ratio. The front end ratio is just your housing expenses, the proposed housing expenses, which are things like the principal and interest on the mortgage that you're going to pay, the property taxes, the homeowner's insurance, maybe the property has an HOA. What they do is they take all of those numbers, they add them together. That's your proposed housing expenses. So that's your front end ratio. So for purposes of this video, let's say that you have a $3,000 principal and interest payment. You have property taxes at $500 and your homeowner's insurance is going to be $100 a month. Well, that's $3,600 combined there. Well, $3,600 divided by 10,000, because that's your gross monthly income, tells us that your front end ratio is 36%. Now, earlier in the video, I mentioned that USDA has a requirement of a back end ratio of no more than 41%. But I also mentioned that you can typically go higher on that number when you have some compensating factors, things like good credit, things like some money in the bank. So let's say you do have some of these compensating factors and you can get your debt to income ratio up to 43, 44%. Well, if we have a front end ratio of 3,600 and we can go up to a 44% back end, that means that we can have up to $800 in monthly debts that show up on our credit report in order to still meet the basic loan requirements for the debt to income ratio. Because what they do is they take your proposed housing expenses from the front and then they add your monthly debts that show up on your credit report, things like your car payments, your credit cards, your student loans, things that you had to apply for in order to get credit. Maybe you bought some furniture, that sort of thing. Installment and revolving debt shows up on your credit report. What doesn't show up on your credit report is how much you paid for groceries, your cell phone bill, your electric bill, your gas bill. Those things don't show up. Now, As a potential home buyer, these are things that you should be factoring into your budget, which is something you should be creating prior to ever talking to a lender. That way you know exactly how much home you can actually afford. Because when a lender runs the numbers for you, they're just going to tell you, hey, you can qualify for this much. They don't know how much you spend going out to dinner or how much you spend on groceries or all of these different things. That's why it's important for you to budget. But going back to the debt to income ratio, you have that front end ratio in our example at 36%. And let's say that you have a $500 car payment. That's all the debt you have. You don't have any credit cards. You don't have any student loans. We know that you have a $3,600 proposed housing expense and you have a $500 car payment. Well, we add those together, that's $4,100. Well, if we take $4,100 and we divide it into 4,000, that's 0.41 or 41%, which would mean that you would meet the basic requirements for USDA loans. Now, every time I do this, I always have people trying to calculate this on their own. They're getting their credit, they're trying to run calculators online, trying to figure out how much their housing expenses are going to be, and figuring out whether or not they qualify. Please don't do that. Use this video for novelty purposes only. Use it as kind of a guide how a lender will calculate your income in order to buy a home. But if you're serious about buying a home and you want to see if you can qualify, don't use this information. In fact, talk to a lender, go through the pre-approval process. Now, if you don't have one, you're not sure where to start, do me a favor and check the referral link below. I've created a link of people I know, like, and trust that will guide you through this process for free. There's no cost. They'll run over all of this stuff with you and they'll help you determine whether or not you qualify. And that way you're not having to do these back of the napkin calculations where they could end up being wrong. So do yourself a favor and talk to a pro. Now, in my experience of 20 years in mortgage and real estate, what I can tell you is most people don't meet the loan requirements because of the debt to income, because they just have too much debt versus their income in order to meet the loan requirements and or in order to meet the type of property that they want to buy or that they need in their life. So if you can get by the hurdle of debt to income ratio, you can find a property in a rural area and you meet the income requirements and you have that 640 or better credit score, there's a high likelihood that you're going to be able to qualify for that USDA loan. But as I said earlier, don't count on this video and say that you're pre-approved. Actually go to a lender, talk to them, submit documentation. Don't just talk to them. If you talk to them only, that's a pre-qual, and that means absolutely nothing in the real world. You need to provide documentation, which are your W-2s. If you're self-employed, you're gonna have to provide your tax returns. You're gonna have to provide your last 2 pay stubs on top of checking and savings accounts. And they're gonna run your credit in addition to that, but that's how they're going to determine whether or not you can buy a home, whether or not you meet the eligibility in order to do a USDA loan. Now, there's a couple of additional requirements that we're gonna talk about here in just a minute, but what I wanna say is when you're going through this process with a lender, also ask them if you qualify for any other loan programs out there and get them to put those loan programs side by side. Maybe you qualify for an FHA loan in addition to a USDA loan, and you also can qualify for a conventional loan. Have them put all of these loan programs side by side, tell you how much down payment each would require, how much the monthly payment would be on each, and then ultimately let you make the decision which loan program is right for you. Now, one of the other nice things about USDA loans on top of the no down payment is that they don't have a max loan limit. Conventional loans and FHA loans have a max loan limit where they will not lend to you more than a certain amount of money. USDA loans do not have that requirement. So that means if you meet all the other eligibility requirements, you can go as high as you want to with regards to the loan limit and still meet USDA qualifications. And one other really nice thing about USDA that no other loan program allows is that if the home you're purchasing actually comes in with an appraisal higher than your purchase price, you can use that additional money towards your closing costs. So let's say, for example, you're buying a home that's $350,000. That's the purchase price. But let's say you get an appraisal and the appraisal comes in at $360,000. Well, USDA will allow you to go up to $360,000 and use that $10,000 that's above and beyond the purchase price towards your closing costs. So you can truly buy a home with no money out of pocket, no down payment and no closing costs. But with that said, Let's say that the property doesn't appraise for more. The chances are you're going to have some closing costs on that loan. People think just because it's a no down payment loan that there's no cost involved. Well, no, that's not true. There's no down payment involved, but there typically are still closing costs when buying a home. Now, sometimes you can get a credit from your lender, sometimes you can get a credit from your realtor in order to cover these costs, but it is something that you need to be thinking about when you're buying a home. You need some additional funds. In fact, if you're looking to buy a home and you have no money in the bank, no additional savings, no money for a rainy day, you probably shouldn't be buying a home even if the lender allows it. You need these additional funds just in case something happens. Say you lose your job or something on the property breaks and you need to fix it. Well, it's always good to have this additional money so that you're not stressed out and that you can take care of the problem at that time. But when I'm often talking to first-time home buyers, I'm telling them the same thing. You need to have some money in the bank. You need to be comfortable with the payment. You also need to be thinking about a longer-term time horizon when it comes to buying a home, especially when you're putting no money down, because home prices don't always go up. Sometimes they move sideways. Sometimes they can even move down. So unless you have that longer term time horizon, if you need to sell that home, you could end up owing more on that home than it's actually worth. So please take that into account when you're buying a home and putting little to no money down. Now, one last thing I want to talk about today when talking about USDA loans that's similar to FHA loans is the fact that USDA does have an upfront mortgage insurance premium. They charge you 1% of the purchase price when you're buying a home. It's actually financed into the loan. Now, every single USDA loan has this fee. There's no way around it. Now, you can choose to pay it out of pocket so that you're not financing it. But in theory, this is how it works. If you're buying a $500,000 home, your purchase price is going to be $505,000 if you put no money down. So you're actually going to be financing more on the home than it's worth, in theory. And that's another reason you want that longer term time horizon, because there's no equity in the property when you're buying it, because there's no down payment, and because you have this upfront mortgage insurance premium that you have to pay at the time of closing. But that's one of the benefits of using USDAs. There's no down payment required. And the mortgage insurance is the cheapest mortgage insurance of any loan program out there that has mortgage insurance, and it's 0.35%. Now, I know a lot of people watch this video and go, why do I need mortgage insurance? Well, mortgage insurance is required when you're buying a home and you put less than 20% down on any loan program out there, aside from VA. VA is a special program for veterans, but if you're buying with conventional financing or FHA financing and or USDA financing, you're going to have monthly mortgage insurance. Now, this is in addition to that upfront mortgage insurance premium that I mentioned earlier. And this fee is paid every single month along with your mortgage payment. And how you calculate this is you take your purchase price and you multiply it by 1.01, which is adding that upfront mortgage insurance premium that I mentioned earlier. So you take that $500,000, you multiply it by 1.01, gives you a loan amount of $505,000. Now, this includes that premium that we talked about earlier. Now, you take that amount and you multiply it by 0.0035, which is 0.35%, and that gives you an amount of $1,767. Well, then you divide it by 12 because there's 12 months in the year, and that gives you $147. So in addition to your principal, interest, taxes, and insurance, you're going to have that monthly mortgage insurance, which in this case on a $500,000 purchase is $147. Now, the reason you have mortgage insurance is because it essentially protects the lender against default. It's not insurance for you, it's insurance for the lender. So if you default on your loan, this insurance that you're paying essentially protects them. It repays them for the loan that you defaulted on. And the reason they require this is because they're giving you a loan with no money down. There's no skin in the game on your behalf, and therefore it's a more risky loan in their eyes, and this is how they protect themselves. And the last thing I want to talk about today's video is employment and income. Now, we talked a little bit about income earlier, having to meet the income qualifications, but another thing you have to consider is you need steady income and you need steady employment for at least the last 2 years, which means, yes, you can change jobs. Yes, you could have had a little time off in a job, but you need to be consistent in your employment. If you've only worked 6 months in the last 2 years, well, then that doesn't really meet the 2 years of steady income and employment. And on top of that, you really want to be in the same line of work during that period of time, receiving the same type of income, if you will. You don't really want to go from a W-2 to a 1099 during that period of time without having at least 2 years history of it. But these are a lot of things that you need to run by a lender. Instead of watching a video like this and saying, check mark, I meet this, X, I don't meet this. Talk to a lender, have them run your credit, have them look at all the documentation, and that way they can determine whether or not you qualify, and they can give you things that you need to work on if you don't qualify right now. Now, as a reminder, if you don't have somebody that you know, like, and trust to guide you through this process, that referral link that I mentioned is right below. Now, I realized I went over a lot of different things in today's video with regards to USDA loan requirements. Some of it you might have understood, some of it you might not have, but that's all the more reason to make sure you're working with a professional in the process. Now, if this is one of the very first videos you're watching on buying a home, you don't really understand the process, not sure where to start, I created a first-time home buyer course to guide you through the home buying process from A to Z, walking you from everything to getting a loan, to how to find a real estate agent, to writing offers, how to negotiate, and even closing on the home, what all of that means. So if you have any interest in becoming an expert in the largest financial transaction you'll ever make in your life, do me a favor and check that link below. Now, after watching this video, you may decide USDA is not the right loan for you because of some of the requirements that I mentioned in today's video, and you're wondering what other loan programs are out there for you. Well, do me a favor and check out this video here.